On my radio show, what I try to do is, again, teach people what they're doing wrong if I see they're doing something wrong, and how to trade, again, like the house, like the firm. The point I also try to make is that the goal of what they're trying to do, even though they don't realize it, is to take whatever cash they have and make that cash produce as much additional cash. And to do that, you have to utilize it to its fullest. And the worst way to utilize it is to put out a big chunk of money, buy a bunch of stock, and sit on it. Then it's just sitting there, doing nothing, many times going down, losing value. And those are the people that just, end up making nothing and losing until they have nothing else to lose and they're out. So what I'm trying to do is change people's thinking. In the beginning, people truly bought stock to invest in companies. I mean, it was very pure. It was what it should be. But then somewhere along the line, as the brokerage firms started getting greedy and as more people wanted to start playing with the market, then they started figuring out ways to entice more people in. They came up with products to entice people in, just like any other retail business. You come up with a sale or a marketing niche, whatever. And so once they started that, and they saw how they could rake in the money, it just took off on its own, and now it's driven by greed. The general public is bombarded with information, as I was, from an age that they're old enough to realize what they're hearing, and maybe even prior to that subconsciously. But they are constantly bombarded with information that the only way to participate in the market is to buy. If the market goes up, that is good. Days that the market's up, everybody's happy. Days that the market's down, everybody's sad. So things that go up are good, things that go down are bad. They come out with stories and hype on different companies, why they're going to do well. Again, marketing ploys, right? Hyping up this company, that company, so that all this media information, the public starts forming opinions about companies, about the stock market in general. And once they form these opinions, then they start forming a bias on this stock or that stock. At some point, the public, the average investor, thinks that they can predict the future of a company, of the market in general, whatever it is. So they think they've heard enough, they know enough, I know what it's going to do, no problem. So then they get involved. So now they're making decisions, they're making trades, they're placing money on emotion, because emotions, fear, greed, ego, right? Then at this point, again, they think they're predicting the future there, or they can predict the future, so they start taking positions totally emotional. It's not based on anything other than what they've heard, which comes from the media, which was originated by the brokerage houses to convince the public to do what they wanted them to do. It's like a casino because it is truly gambling, because they are doing what they're doing based on emotions, and they're doing that in a world that is rigged against them. You can go into a Vegas casino, right, and you'll hear the bells ringing here and there, so people are winning, right? But those people that win most times will stay there until they give it all back. Or the people that don't get the bells will just stay there until they run out of money and leave. The market is an up and down roller coaster for all these people, but in the end, if they stay there long enough, they're going to give it back. And that's by design, not by chance. In 2008, $178 trillion was lost by public investors, whether the people that were in IRAs, mutual funds, so on and so forth, people that owned, individual traders even, that owned money, and they either wrote it down, hoping it would come back up, didn't believe it was happening, whatever, but again, they lost money. The opposite side, the other realm of reality is the firms make money every day, every year, no matter what. 2008 was actually one of the better years for firms and for people trading as the firm, because they make money if the market goes up, stays flat, goes down, it doesn't matter. They don't have losing days. The market, as we all know, is a zero-sum game. So if you have a zero-sum game and you have a bad odds on one side, the opposite side has to have equally good odds. That was the most valuable thing that I learned, far more than money, was how the market works from the inside out, so that I could take advantage of that with that perspective of being the house. The goal is for the clients to part with their money, the firms that take that money, and when their clients are out of money, a new busload of clients come in and they start over again. There's a never-ending supply of suckers out there.